Well, good morning, everyone. Thomas Montgomery with Smart Money Alliance and IIMFL. It's my pleasure to visit with you for a few minutes this morning. As you probably know, we get together most Mondays through Fridays, weekdays at 8 o'clock Central, or a minute or so before. We usually get started early. And we talk about tactics, strategies, tips. This is where our distribution partners get together to learn more, share ideas, share best practices. Of course, we are more than excited to schedule one-on-ones with you to make sure that your specific questions are answered, that we have goals and that we're accomplishing those goals in terms of the number of clients helped in the income that you generate. However, what we do at this time is go through kind of what's new, what's working, any updates. And so we're going to talk today about the new IIMFL Revolving Business Line of Credit. Couple disclaimers. So we've talked about a different line of credit a couple weeks ago, and that line of credit was predicated on the last 3 months of your credit card receipts. So for small business owners that accept credit cards, that became the collateral and the validation of cash flow for that line of credit. That is different than what we're talking about today. When I sent out the email to all of you to let you know about our topic for today, there was some confusion on that. What you know, what I know, is that there are lots of different sources of capital. Each have their own underwriting criteria. Our approach is not to go solicit entrepreneurs based upon a specific source of funding. Not on a specific type of SBA loan, not on this revolving business line of credit, because until we've gone through the 28-day process of educating them, building their financial literacy, building their loan package, we don't know what they qualify for, right? Because you know what I know, you have to meet the underwriting criteria to get approved. That's true if you want to go get a mortgage for you and your family to live in. That's true if you want to go get a loan or line of credit or extensions of credit for your business. So I wanted to give you insight of how this line of credit works, because it's going to be a resource that will help lots of small businesses. But again, we don't match the type of capital with the client until we've built a loan package, because it's through that process that we understand what credibility factors they have and what they would qualify for. The other important reason for covering this today is we're starting to see the lending markets open up. Make no mistake, since the pandemic hit, many lenders have become more restricted in issuing loans and extensions of credit. Now, has there continued to be access to capital during the past 6 months? Yes. Is it tighter than it was 7 months ago? It is. But this is a great indication that it's starting to open up. We received just yesterday word of this funding vehicle becoming available again. It was available earlier this year, but not for several months. Before I was even comfortable bringing it to you, I wanted to validate that it was open. So we immediately applied ourselves, and it worked. The funding is in our account this morning. In less than 24 hours, this funding vehicle funded. Money has been directly deposited into our business account. So you can't beat that. Again, always remember that there's underwriting criteria. This is not a socialistic endeavor where you just need money, you get money. You must qualify. So even for this IIMFL Revolving Business Line of Credit, you must qualify. It's too good to be true to think, oh, I don't have to qualify. I'm just going to get money regardless of my circumstances. So we're going to go through what the qualification requirements are here. Okay, so with that being said, we've covered the first paragraph. Great news. The marketplace is opening back up. More sources of capital are becoming more readily available. And this one we've absolutely validated, and the proof's in the pudding. The deposit was made this morning into our account. Now, if you're looking for a pitch of how to talk about this as a potential funding source. Again, you never want to promise to a client that they're going to qualify for any one given source of funding, because they may not, right? You can't change the underwriting criteria. I can't change the underwriting criteria, but what we can do, take them through the 4-week process, build their financial literacy, build their loan package, and see what they qualify for. But we'll go ahead and go through the pitch, and then we'll get down to the specifics. So the pitch here is, if you own a business, you probably already know that sometimes you need access to working capital to help you grow. Even the most successful small businesses experience late invoice payments, urgent unplanned expenses, and other short-term situations where cash flow is less than certain. In cases like these, access to some extra funds can mean the difference between closing your business or surviving the tough times and coming out on top. So when we talk about lines of credit are attractive because there's an approval made and you can go pull from the funds when you need them. And if you pull from them, of course, you're going to incur interest charges. But if you don't pull from them, then there are no interest charges. And that's different than what we would call a term loan. A term loan could be guaranteed by the SBA or not, but that's where it's a set amount. It's all funded into your account up front, and then you have monthly installment payments for a defined term. Hopefully we're all clear on the differences between a line of credit and a term loan. Again, if you've not gone through yourself the small business certification curriculum, because now you know that those 4 lessons are available on the IIMFL website. You don't have to have a password, you don't have to pay anything. You can go through those 4 lessons. If you've not built that level of foundation of understanding of small business finance, strongly encourage you to do it. Otherwise, you're acting kind of recklessly in this capacity. All right, so let's get to the specifics of the IIMFL revolving business line of credit. Again, not blowing smoke. We were notified yesterday that this source of capital opened back up, and we immediately applied to validate it because I wasn't going to waste your time or mislead you saying, oh, it's available, but it's not really funding right now. It is funding. Okay, so it's not perfect. One imperfection is it caps out at 100,000. So this may be one tranche of a capital raise for a client. This may not meet their entire capital raise. And that's commonly going to be the case. And we talk about that in the 27 Mistakes YouTube webinar that we recently did that's on the homepage of our website. It's not uncommon for small businesses to have to go through steps or tranches to get to their ultimate capital raise. I believe this should be a tranche of capital that should be part of every small business's capital raise. Of course, they do have to qualify. We'll get to that. Second bullet, we have to have a business bank account. You and I are already out there teaching them, educating them. You need to run a business like a business, and that includes having a business bank account. But for this specific source of capital, it's not negotiable. You must have a business bank account. Now, think back, and we've talked about the 3 C's of lending. We'll step even further back. So there's 3 ways that a small business or any business can get capital to grow: debt-based, equity-based, and earned income, or any combination of those 3. Debt-based, equity-based, earned income. Debt-based is where we borrow money that we have to pay back. Equity-based is money that is injected that we don't have to pay back. And earned income is the best of all. That's where we have excess profits from our sales of products or services. Thus, we have additional capital that we can reinvest back in. When we're talking about debt-based capital, we learned about the 3 C's. We've covered that in a prior training course, and it's certainly part of the small business certification. If you're not familiar with the 3 C's, you really, really need to go through the lessons in the small business certification. Because if we're going to try to get debt-based capital, we have to at least meet one of 3 credibility factors, the 3 C's. We either need to be credit-worthy as a business or individual. We need to have collateral, and/or we need to have cash flow. So to my knowledge and in my experience as a former SBA advisor, former college professor, former Deloitte senior consultant, if you don't have at least one of those 3 C's, then we need to fix that and get at least one of the 3 C's, because we're not going to get debt-based capital if we don't have at least one of those 3 C's. Now, the more we have, the better, but we need at least one of those 3. You can see here that we don't need to really have much credit. They're going down as low as a 500 personal credit score. So, and 500 is not credit worthy, right? Not a very high threshold. So almost everyone, not everyone, but almost everyone has above a 500. And if you're not above that, almost anyone can get above that within a 30-day period, because it's so darn low, it doesn't take much to jump above a 500. So when you're looking at this, you say, okay, well, this fits into debt-based capital, doesn't it? It's money that I have to pay back. It's not a gift. It's not an equity injection. It's not earned income, okay? So it's going to have to be based off of at least one of the 3 C's. And we can discern, well, it's not built off of credit, right? Because someone with a 500 credit score is not going to qualify for a $100,000 injection if the underwriting is predicated off of credit, because this is not credit worthy. So what are we left with? Well, then this is going to have to either be based off of collateral or cash flow. Collateral means, oh, we have to bring some paid off asset and go pledge it. And so then if we don't make the payments, they come repossess it. You know, paid off vehicles, real estate, retirement plans, what have you. This is not predicated on collateral. So what's left? There's only 1 C left. Everyone's thinking, well, if it's not credit based, and it's not collateral based, it's cash flow based. That's right. So the business can be a startup. Startup is defined by the SBA as 2 years or less in business. Now, obviously, we need to be at least 3 months in business because that's a requirement. So we couldn't be day 1 of a business and qualify for this type of capital. We'd have to be open for at least 3 months and have 3 months business bank statements. So now you're probably connecting the dots. Oh, okay, I see. So this is a revolving line of credit that's not predicated on personal credit. It's not predicated on collateral, but they do want to see that we can afford to service the debt. And, you know, that's kind of the way that lenders work, right? They want to be paid back. They want to feel confident that you'll be able to pay them back. So you might be thinking to yourself, oh no, do I have to have a bunch of cash flow to qualify? No, you don't. But of course, it's insane to think that if you have very little cash flow, that you're going to get a real big line of credit. That's insanity. That's irrational. So you and I won't ever think that way. Customers may think that way because we've not educated them well enough or well enough yet. So there's going to be a relationship, of course, between how much cash flow you have coming in and how much you can afford to pay, right? That's just logical. So with that being said, some great news. It's a fast and easy application. And again, we're a firsthand testimony. We applied yesterday. The money, when I came into the office this morning, checked the account, it's there. 24-hour turnaround. Now they say 24 to 48 business hours, but in this case, it was literally less than 24 hours. And again, to clarify, this does not have anything to do with credit cards. I know that there was a different line of credit that we talked about, that they do a dollar for dollar match, which is not what we're talking about here, for a maximum of 100,000 based upon credit card receipts. So that's a different source of capital. There are some businesses that are not bringing in that much in credit cards to use that as the trigger for funding. Here, it certainly is looking at the deposits into the bank account, but it's not predicated on credit cards. And again, you're able to get an approval, pull from it now, or wait. As you pay down, you can go back and access, and these aren't credit cards. Don't mistake. These are not business credit cards, which we call that unsecured business finance, UBF, and we work with small businesses frequently using business credit cards as kind of a hybrid business line of credit, but that's not what we're talking about here. This has nothing to do with credit cards. All right, so with that being said, what do we want to take away from the discussion today? Credit markets are opening back up. So the clients that are in the system already, we're going to be able to get funded more quickly than we were when the credit markets were tighter. And this is a very attractive source of capital, especially for those that are not credit worthy. They don't have that C. You might say, well, here's a challenge. I know a lot of small businesses, but they don't have much cash flow yet. Well, that's a fundamental problem, isn't it? Right? If you have a business that's not generating much in sales, that's a problem. And so we need to figure out how to help them do that. I realize in some cases you need an injection of capital to get the infrastructure built to be able to flip the switch on and operate. I respect that. This is not going to work for pre-cash flow entities, right? Because they have to have a bank account and we have to have at least 3 months of bank deposits. However, we do have the Opportunity Fund. We've talked about the Opportunity Fund before. I'll briefly mention it now. So let's say that a small business owner is not cash flowing for whatever reason. The pandemic has shut them down, their doors are locked, whatever the reason is, it doesn't matter. Then we can use the Opportunity Fund to inject up to $10,000 a month into their business. That goes into their business bank account. So all of a sudden now they're qualifying for this. That's improving their financial statements. It's improving their bank rating. It's giving them working capital. So what's interesting about our model and what you and I do to help people is if people have credit deficiencies, that's not a permanent problem. Credit is fluid. Credit can be improved. If they have cash flow problems, cash flow is fluid. That's not a problem. We can help them resolve cash flow problems. Collateral, the third C, is a little harder, right? Because you're going to have credit and or cash flow to go buy items that would serve as collateral. But no one's stuck, locked out of the capital markets. Even if they have none of those 3 C's, we can go to one of the other 2 sources of capital, which include equity-based and then earned income. What questions do any of you have about the IIMFL revolving business line of credit? Okay, Toussaint's asking more about the Opportunity Fund, and so I'll summarize that, and then we'll continue to field everyone's questions on the business line of credit. So the Opportunity Fund addresses that third stream of revenue, right? Or third source of capital, I should say. Because Toussaint, what we said is, if you want capital to grow a business, it either needs to be debt-based, money that we borrow, we have to have at least one of the 3 C's. It can be equity-based, you don't have to have any of the 3 C's, or earned income. Earned income is the best. Earned income simply means that we're selling our products, our goods, our services, we're paying our bills, there's money left over, so now we can re-inject that back into the growth of our business. That's ultimately the goal. Some small businesses, Toussaint, do not have the revenue to generate a profit for whatever reason, so the Opportunity Fund fills that gap, it fills that void. So they come aboard, they become an affiliate of yours. They don't go out and sell something to someone. What they do is simply help us take the message out of the affinity program to key influencers, churches, chambers, co-working spaces. We just executed an agreement yesterday with a big African-American Chamber of Commerce, by the way. But separate from that, so the Opportunity Fund, they're spending a little bit of time helping educate and introduce key influencers to the affinity program, and then they're paid as an affiliate from the results of that, which averages $1,000 per conversion. So that's the inner workings, Toussaint, of the Opportunity Fund. Hopefully that helped. Monique asked, yes, so now our funding committee has this arrow in our quiver. We used to have it in our quiver, but I'm telling you, they turned it off. But they just turned it back on, to our knowledge, as of yesterday. Maybe it wasn't just yesterday, but that's when we were notified. And again, we validated it, and it absolutely works. It absolutely works. And I'll tell you, we have a couple associated businesses. The business that we chose to run this through had a bank balance of I think, a low to mid 3. So it wasn't one of our bigger entities that was approved and immediately funded. But yes, ma'am, we will have this as one of the resources now that the funding committee can recommend to our clients. And again, remember, this may just be one step, one tranche of the capital raise. This is not meant to be the end all and be all, because we all know that the purpose of lines of credit is not to go use 100% of it and keep using 100% of it. That's the wrong instrument. It's meant to cover the dips and valleys that we may have as a business. If we need $100,000 for an extended period of time, we probably should be doing a term loan. There's not a, Tony asked, monthly minimum. There's not a specific monthly minimum. What we'll do is we'll take a look at the business bank account, and then ultimately the underwriting algorithms will decide if an approval is made or not, and as far as how much. So there's not a stated minimum, but there has to be a reasonableness factor. If someone is bringing in $150 a month, then there's no reason to even pursue this, because their ability to service the debt is negligible. But there's not a stated minimum. Thank you, Tony, for asking. Toussaint asked about the data to show cash flow. So as you know, Toussaint, when we build a loan package, we collect the last 3 months of the business bank account statements. So that's how we in our model look at how the cash flow is going of a business, as well as interim financials and past tax returns if applicable. For the IIMFL revolving business line of credit, they're going to look, typically, there's 2 options, quite frankly. They could look at your QuickBooks data or FreshBooks or whatever accounting software you use. What I prefer, and what we did, is we just provide them access to our business bank account, so then they can look at the business bank account from the inside. They literally log in to the bank account and look at the balances, the activity, and make a decision. And so, yes, Joseph, you get paid as an affiliate. You get paid 1% of the capital raise. As a branch manager or joint venture partner, you make 5% of the capital raise. So let's do that math. So Joseph, you bring in a client. Let's just say, for simple math, we get them a $100,000 business line of credit. Then you're going to make $5,000 off of the capital raise for that client, which is great. Dr. Austin asked about 3 months of bank statements. Well, it's October 1st now, so it would be the September bank statement. That's the most recent ended month, August, and July, of course. Peggy's asking about a flyer, and again, it may be a philosophical difference, not that you're right and I'm wrong, or I'm right and you're wrong, Peggy, but we don't want to go to the market promoting specific funding instruments, because that'll make people unhappy if they don't qualify for that specific one. So instead, we promote the small business certification, or some of you are promoting the Capital Ready Program 2.0, which starts with the same 4-week curriculum. We build their loan package, we educate them, and then we decide what do they qualify for, and or what would need to change for them to qualify for other options to get the ultimate access to capital. So we don't go out and push SBA 504 loans. We don't go out and push this business line of credit. Instead, we bring them into the program, to the curriculum, we educate them, we identify what they would qualify for, and then we make that presentation to them. All right, and Annette asked about the Capital Ready 2.0. So when clients enroll in the Capital Ready 2.0, we're guaranteeing them a minimum of $100,000 capital raise. That $100,000 capital raise may not come all in one tranche. That may be too good to be true for their circumstances. So this will be a funding resource made available to those clients, Annette, and if they qualify for this, then it will be recommended that they use this at least as one of the tranches. And of course, the available credit that they have access to would count towards the $100,000 guarantee. Hopefully that answered your question, Annette. If I missed it, let me know. Joseph asked, if a person has all those things listed, what else can get them denied? That's a good point. I mean, these are the major points, but we're not the lender. We're not the extender of credit. So these are the filters that we'll be looking off of. And then there's not going to be a hard credit inquiry. So at that point, we can go ahead and try. But even with this, there's only a soft inquiry on the front end, not a hard inquiry. So then we would try it. But you're right, Joseph, there may be something with the business or with the business owner that would keep them from still getting approved. But these are the major points that we'll be working off of. And it's an art, not just a science. And so in some cases, we'll try to get a client a certain type of capital, and they may not qualify for that type. So we'll have to pivot and move on to a different source. All right, so Travis, and Travis makes a great point, and I see this, and I had a client just this morning ask about it. It is best practice to have a business bank account, and you and I are out teaching this. And so while you may receive money through Cash Apps, through Zelle, through PayPal, or what have you, to run a business properly, those deposits need to go into a business bank account so they can be accounted properly and make sure that we're compliant, and then also for sources of capital like this. And so it's certainly possible. We have a client that, we have quite a few clients coming aboard that are in the beauty and hairdressing industry. And so what's happening is we're setting up a number of affinity relationships with cosmetology schools, and that's kind of flipped the floodgates on, which is a great problem to have. With that being said, that's an industry that in many cases they're being paid cash for their entire services or cash for tips. And so those aren't getting captured often in their business financials. And so I'm not here to counsel on tax compliance, but you can imagine there's some issues with that. But certainly if you're running a business and you're not putting all of your deposits into your business bank account, then you're shortchanging yourself in terms of positioning yourself for an access to capital. All right, so Toussaint asked, how can he apply? So again, it's the same process. All of our clients come through the 4-week process. We call it small business certification. Whether it be you, Toussaint, or any small business owner across the country, you can either come into the small business certification directly, 28-day, 4-week process, much improved support and structure. It is spotless now. Or you can come in the Capital Ready 2.0, which still starts with that same 4-week curriculum. We just have more responsibility on the back end with the $100,000 guarantee. But regardless of which source of capital, that's where we always start. We need to educate the client, and we need to build their loan package out. All right, so Doug has a question here. Okay, so he just recently started the small business certification. So that's a great question. What happens is we spend 4 weeks going through a very specific curriculum, gathering data, building the loan package. At the end of that 4 weeks, we collect all the data, we put it into a shared Dropbox. It's secure, so the client and we have access to it. Then our funding committee reviews all those data elements so we can make recommendations on the right type of capital raise based upon that client's mitigating circumstances. So in most cases, we won't make recommendations of a capital raise until that loan package is created so we can look at the whole picture. So we'll have people that enroll and, and they're in week 1, they're like, well, I want to go to funding. Well, we need to educate you first. We need to be on the same page, and we need to build the loan package, and that's done through the 4-week process. So the short answer to your question, Doug, is once you've completed the 4 weeks, and I think you're in week 1 or week 2 now, then we will build the loan package and make recommendations, and it may very well this may be one of those. All right, Alyssa asked, well, and that's a good point. So Alyssa's digging a little bit deeper, and so a number of us, we have, and you may have received a PPP loan, which is really more of a grant. And so that money would have gone into your business bank account. By law, it was supposed to go into a business bank account. We've seen some instances where they deposit it into personal accounts for reasons I don't know. But yes, I mean, that would purely help you, right? Because that's going to give you a bigger bank balance and more cash flow. But no, this does not require that you've gone through the PPP. And then Toussaint's asking a question. So Toussaint, again, it's my fault when you don't understand. It's not your fault. We always, for all clients now, so I'm not saying it's always been this way, but this is the model we have. This is what we've evolved to, and it's working really, really well. It's working infinitely better than anything that we've done before. Clients are happy, referral sources are happy, high customer service, quick turnaround. So the model is we build the loan package out, going through that 4-week process. That loan package is built the same way for all clients. So rather they're just going for this line of credit, or they're going for an SBA loan, or we're doing real estate, or we're doing a big equity deal. We had a client come in yesterday looking for $500 million. It doesn't matter. The first 4 weeks of every client is uniform. It's the same. We're going to teach them the basics that they need to know. We're going to build the same elements of a loan package. So that is consistent, regardless if we're going after a little capital raise or a large, regardless of what preferences the client may have for funding, because truth comes from the data that we collect. So we're going to do a full data collection, including the KPP. Okay, well, we filled up our 30 minutes. I hope, in summary, this gives you continued optimism about the regrowth of small business in America, because funding is becoming more available. It's certainly been constricted over the past few months, but it's starting to open up, and this is a great example of how it is, because this source of capital was closed until yesterday. It reopened yesterday, and it's absolutely funding. I know it's funding, I told you, because the money's deposited, right? You can apply for up to 100,000. We didn't apply for 100,000. We applied for 60,000, and we got 60,000. The amount that you're going to get, of course, is going to be based upon your credibility, looking at these factors. All right, well, thanks everyone. We will regroup again tomorrow morning. Have a great day, and let us know if there's anything we can do to assist you. Thanks, bye.